Hey, everybody. We just wanted to reach out and say hi and touch base. This is Wes Holt here in Salem, Oregon.
Yep, and Dave Littlejohn down in Roseburg, just doing another update. This is coming from the investment committee, executive committee. We have more people on the investment committee, but we only want to put so many people on the call. It gets confusing otherwise, right?
Exactly. And so this is kind of a fun, maybe a little bit nerdy, maybe a little funny.
Maybe a lot nerdy, really.
But we just want to share a couple things that we look at when we're looking at what's happening in the economy, what's happening in the market, and how is all the news that's coming out that's getting put out by the executive branch of our government as well as Congress. How is that affecting stocks, which is nothing more than how does it affect the health of businesses that are currently operating? And so just on a fun side, one of the indicators, I had a friend of mine that he called his wife and said, honey, I need a haircut. I mean, my barber shop is closed. I've got to get this done, right? And I had another friend, same thing. And they did a crew cut. And I'm thinking to myself, when I see about, 50% of the men in America with crew cuts, then I know that we're just about at the bottom and things are going to look up from there.
Right. We've taken our social distancing seriously. It's bound to start working, right?
Yep.
There's a lot of indicators that we could look at, and we may look back and discover that that's really true. It's funny, history does that, right? In the 1920s, there was something they called the hemline indicator, right? The more conservative the times were, the longer the hemlines were for ladies' skirts. And when economic times were booming, those skirt hemlines started to come up with the economy. So it's funny how but it may yet be true. We make a joke about it, but we're not going to rely on that certainly to make our investment decisions. And so one of the things that I wanted to do, bring up some of these points, because I'm getting a handful of people, they're emailing and they're asking questions. What do you think about this stock or that? Is it time to buy? And so we wanted to talk a little bit about how we are evaluating the markets, the tools that we're using, and the why behind some of what's been going on in our decision-making process. Because people originally questioned, wow, you raised cash, right? You sold some stocks and raised cash on March 9th. What were you thinking? Well, we're going to show you a little bit about what we were thinking and where these numbers come from today. So
one of the indicators that we like to look at is there's two types. There's one that's called fundamental, and there's one that's called technical. And fundamental is really about what's happening with maybe a specific company. How is their sales? How is their profits? Are they giving any money to the shareholder in the form of dividend? And then the other fundamental thing that we would look at would be what's happening on a kind of a global or a macro scale. So that's one of the indicators that we look at. The second side is really the technical indicators, and that's where we're looking at more human behavior, which is when people buy, when they sell, how the markets move and the movement of those in a pictorial form. And so, David, I know you had some fun things that you wanted to share with us in that.
Sure. So let's do this. Forgive me while I make this work, but I'm going to share my monitor real quickly, and it means I have to look in weird places. So we'll do here. And what you're going to see now is a very high level of how we analyze the markets. And I want to show you how we start from a high level and then we drill down to a much more specific level, okay? You're looking right now at some software that I was involved in developing. I have a network of other advisors, and then we started this software back in 2010 in response to the declines of 2008. We wanted a better way to look at the system at large. And what you see here is a look at the S&P 500 on your screen, which is a composite index of 500 stocks. And you can see there's a bunch of little yellow arrows and green arrows. We were trying to figure out a way to determine whether or not it was safe to invest. And so green arrows meant, hey, pretty good opportunity. Yellow arrows meant caution. And when we see red lines here, it actually was an indication that you may not want to be an investor at all during those times. Well, this goes all the way back to 2006. You can see the big decline of last 2008. For the most part, you're in the markets a lot, but not always the case. So what we are doing for our practice when we're doing analysis is we start with the big picture. We look at the whole system, okay, not individual stocks. Let's look at the health of the system. One could argue that the coronavirus or this COVID-19 event is a system-wide risk, right? It's affecting everything and it's global. So we really are seeing a really broad-based effect. And how should we respond to that? Well, I want to draw your attention to the lower right-hand corner of the screen here, where there's these 3 dots. These are 3 macroeconomic indicators that we developed using 3 different ways to view the marketplace. One of them is looking at market pricing itself. Notice that it is red. The reason it is red is the same reason that we raised cash in the system. We saw that the deterioration market pricing was reminiscent of times past where things got pretty dicey. And so we use that as an indication to say, well, if the markets are going to unravel on us, we want to be more defensive in nature. And so when that signal goes from green to red, that tells us danger. So what we were doing is saying, well, if there's danger, then the reward versus the risk of being an investor is not as attractive. So we wanted to insulate ourselves from that additional risk in the market. We're tracking these 2 other indicators very closely. The economic indicator is really similar to what the Federal Reserve uses. Okay, so it's got a lot of the same data points that they're pulling from. It's built in what's called a neural network. It's a learning algorithm that learns the signals and gets smarter over time. It has not yet failed, although knowing the data inside of it and how it's processing, I will admit that it is close, right? Similarly, the credit indicator, which is the one that is my personal indicator that I like to watch the most, it is an indication of the health of the lending system. That was the big no-no of 2008, is when the large financial institutions started failing. It was because they didn't have enough capital to backstop the loans that were outstanding. So right now, the credit indicator is still giving us a sense that credit markets have not failed at this point. And banks are certainly in a better position than they were in 2008 because of a lot of regulation over the past decade that required them to be in a better position and to be prepared for a stress-tested environment and so forth. So we know the system is healthier, but we also know we're going through some unprecedented times. We're at the first of the month here in April. We're yet to see, after all of this very sudden unemployment, how many people are going to be able to continue to make their rent and mortgage payments. It's going to have a material impact on the credit health of financial institutions. So it remains to be seen. But anyway, that's the macro stuff that we look at. And then you can look here at the system-wide positions. We track over 11,000 positions in this system. And right now, only 18% of them have health or what we would call long indicators. That means that the system has not indicated that they should be sold. Okay. When you have 82% of the positions in a sell indication, it's like a voting mechanism that says 82% of the market's not healthy. Well, keep in mind, some of the positions we watch are inverse positions. They go up when the market goes down. So that may even be misleading within this statistic. But what we know is the system health has been taxed very, very heavily right now. So what we do is, with that as the backdrop, knowing systemic health is an issue and knowing that risk seems to be prevalent across all of the asset classes right now, because both the credit indicators about to trip over, we think, markets have already tripped, and we see very few positions with buy signals. It tells us a few things just intuitively, right? But really what we should talk about is, how do we figure out if things are unhealthy, where are they going to go? Now, Wes, I drag you through this all the time, right? Wes and I have known each other, it's probably been 12, 13 years now?
Yeah.
Yeah, and so we've we've gone through this, and he's, I don't know that it was teasing me, but at this point, I may have even made a believer out of you. Uh, Markets tend to forecast things based on previous behaviors.
Right. Yeah. Right. So I'm going to go back to some, and then just to clarify in your mind's eye, think about those macro or those big picture indicators. I like to sail, and we sail on the river in Portland. And when we do that, we have to actually watch the tides. It's hard to believe, but there's a 3 or 4 foot tide swing in Portland, right? And there's a couple of mounds of dirt that are just right outside of our marina. And if we're not watching what's happening in the tidal swings, we may end up aground, right? A rising tide rises all boats, and a lowering tide lowers all boats. And so those macro indicators, all they're saying is we're looking to see the big picture. Are the big picture, is the water going up so everything is great, or is the water going down? Now, the next segment that David's going to share with you is, okay, how far is the water going down? I get my tide information from NOAA, from the Atmospheric Administration, right? North America. Anyway, NOAA, and that's where I get my tidal information from. And so then the question becomes, on a technical side, where do we look for things like potential bottoms? That this is the lowest the tide is going to go, or potential highs, and that's what David's going to share right now.
Right. Maybe a good way to think about it too is like a floodplain, right? So let's do this. We'll go back, and I want to show you a different way to view this. And I want to start simple. I realized that I had a different chart up momentarily, but if we start here, this is just a look at the daily activity of the S&P 500. And you can see this was January down here. And so this is the last couple of months. In January, we started and we went up a little and back down. February, even higher. And then this is the virus. Big drop, little rally, bigger drop, a little rally, and then back down again. You can see lots of zigzags in here. Well, what we want to do is get a sense of where have we been. And if we look back in time, I can use some different techniques to do this. Let's look at a different version of the chart. And I can see here, okay, well, look, at one point we had a nice consolidated trading range. And then when everything fell down, the white line in the middle, you can see it goes clearly negative. But this big blobby gray cloud gets spread wide open. It was really narrow here, and then it got much wider. This is looking at, it's a standard deviation, actually. It's a statistical measurement of daily trading range. We could visually see the risk in the market increase as that cloud got larger. And over history, there have been times where more risk or less risk was present. See here, there was some risk when the markets went down. The cloud got bigger, and then the cloud got narrower again. And now this cloud got really wide. So we have these visual indicators that confirm something's happening. But this is, I think, the story that we really want to tell. Okay, I know there's lots of spaghetti on this picture, but there are a few things you need to know. This purple line right here, that was 10%. When the stock markets peaked back here on February 19th, it fell 10% when it crossed below this purple gray, this gray shaded area with a purple line. Down here to this red line, that was an official bear market, a 20% correction from the peak down to here. But it kept going and going below that, didn't it? So the question is, where does it stop? Well, notice the first indication is that this had a turnaround point right here. And what we look at is that's a pretty good indication of support in the market. So we're looking for areas of support. The initial trend looked like it was going to keep going down and down and down. If it recovers, we look for support, and we look to see if it's going to fall below that support level. How much lower? Well, that's what history is all about. I can look back in time.
If you guys ever go skiing, and you go skiing in powder, and I'm not a big skier, but I've been on powder a few times. When you fall down on your skis and you're trying to get back up, you're sitting there packing your foot down in that powder, trying to find support. And that's really what a support level is. It's like really trying to find a foundation so you can stand up and then get back up on your skis again.
Yeah. Now I'm going to use a funny analogy for a second. I want you to think about the stock market for a minute when it's disorderly, like it is right now, where everything has been falling lately, it stops being an orderly market in the sense that there's buyers and sellers. Everybody starts moving one way or the other, right? And so it starts behaving like a pack of lemmings, okay? And a pack of lemmings is not the smartest thing, right? So we need to be trying to use our brains and not just run in the direction that everybody's running. So it's interesting to look back in time at points where the market had major inflection points. This was the fourth quarter of 2018, major recovery in price right here. We're looking at this area compared to this area, and notice there's a lot of similarities to where the pricing is right now. Well, we had expectations at the end of 2018 for what may or may not occur, and based on those expectations, the markets responded. We have a different set of expectations, but we can look and see, well, what might happen? Will we find support here or not? If we don't, where's the next place the lemmings ran to? Well, you have to go back a ways. And it's way down here where you saw a bunch of market trading occur. So we look at the periods where the market, this is what we call consolidation versus trend, right? Sideways consolidation, clear trend, sideways down, clear trend, clearly a downward trend right now. But somewhere there's a point where we're all going to look at this and go, either the entire economy collapses, every company in the world fails, and we have to start over and we start building castles and having kingdoms again, and it's back to the feudal days. Or we find a foothold, the markets recover, some companies don't make it, many do, and we as investors want to own the ones that are healthy and positioned for the recovery. It's a code for saying at some point this will be so cheap that it's just too attractive not to want to buy it. I'm not sure exactly where that is, but we're fishing around right now to determine, does the market hold here or does it break down and move significantly lower? Significantly lower, in our opinion, as an investment committee, could be another 20 to 25% of downside. Should that occur, we expect that those macroeconomic indicators that we were showing you earlier would likely trigger additional preservation moves, meaning we'd probably sell some more to protect further downside. So far, that hasn't happened. So we are not using our emotions for this. We're using these quantitative indicators, because absent any reliable fundamental data, when everybody's guessing, including the government, every day, we need to go to the data that we can use to be as reliable as possible. So this is what we're doing right now.
Yeah, and I think that's really nice to be able to have that twofold indicator, because it really helps us do a better job of managing not only our money, but our expectations. It also gives us specific targets that we're looking at. And it tells us, not emotionally, but if we were Spock and we were saying, right. Hey, let's just let the math do its piece. It really helps us manage our risk as well, because that's really one of our major concerns. It's like we want to be investors until we don't. And when we see that there's more risk for staying in than for getting out, then we want to make sure that we take the appropriate percentage and we take risk off the table so that we can redeploy that asset later at a better value. And so that's the reason why we have these indicators in play.
Yeah, and something that I will point out that's not often discussed in the money management arena. We don't usually discuss this with clients because it's not relevant to the discussion very often. But it's tempting to get caught up in something we call anchoring bias, where, well, I bought something for one value and therefore I can't sell it unless I get back to that value. And that's really a false idea. What we want to do is look at the circumstances and then adapt to those circumstances. And as Wes said, we want to be investors. But here's the good thing about the markets. Opportunities come again and again and again. The opportunities, if you miss an opportunity, another one's right around the corner. Experiencing and codifying a loss is much more expensive, because now you have to find enough opportunities to recover from that loss too. So we're trying to mitigate risk where appropriate. And the idea is not to just blindly stay in the boat regardless of what happens. We have very specific process for how we want to handle it, but the purpose of this was to let everybody know that we are watching this. It's not just, well, we raised some cash, should we go buy something immediately? Be patient right now. There is a lot that is unresolved in this market, and I assure you that maybe we don't find the very, very perfectly timed purchase at the bottom of this market. That is not the point of what our action has been. It has been about risk mitigation. There are times when it's obvious that you want to be an investor. There are times that it's less obvious. But right now, we're still investors. We're just not fully invested. A lot of dry powder means we have a lot of opportunity. So I will just remind everybody, there is a process. Be patient. We are looking at this stuff on a literally daily and oftentimes moment-to-moment basis. So we stand ready to move if and when it is appropriate, but we don't need to be hasty either. There is a process. We will stick to it. I have the same emotions as everybody else, and we're all cooped up and we're all like starting to climb the drapes, but that's why we rely on the process, is because our emotions are the least reliable part of what we do.
Okay. And so before we say goodbye,
Yeah.
well, there's one more indicator, right?
Oh.
When Paula and I were first married, of course, things were pretty darn tight, right? So we're going to the store, buying the kit that changes the color and does the magic. And Wes gets to pull the hair through the little net and put the little stuff on. And so I think the last indicator of the very bottom of the market is when these ladies, man, come home with these kits and say, honey, it's time to color my hair. So
if everybody's becoming a hairstylist, I suppose that that's a pretty strong indicator there. And it's also, maybe we should be looking for the companies that sell that product.
I know, there you go.
All right, gang. Well, look, realize that if you've made it this long, thank you. You deserve a trophy for tolerating our shenanigans here. But just know this, we take this role really seriously. We do want to communicate with you all. I'm grateful, Wes, to have you on the team. And, it's certainly, you've brought a ton to the investment committee in our process. I love your perspective on things. And for all of our clients, I want to remind you too, thank you, I suppose. The phone has not been ringing off the hook. I mean, we are still actively at work and we're hustling, but people call and they ask if we're okay. You guys are really, really kind. We're blessed. Okay. I'm very blessed. My family's been very blessed. And so I want to acknowledge that. But if you need something, please call. Right. And so, I emailed this thing out in the signature. It's got all the ways that you can reach us, but don't hesitate to reach out. We want to serve. We are here and in business because of you. And so it's not an imposition. If you need something, you let us know.
Yeah. So with that, we just want to say blessings to you. Just stay safe, stay healthy. And then again, just to reiterate, David and I and the team are here together for you. If you need something, please reach out. But we're on it, and we're just so grateful for that year in our lives, and that even though we're physically disconnected, we can be socially connected. So with that, I just want to say thank you. Blessings from Salem. And I'll pass it back to Dave for a close.
All right. Yep. Thank you from Roseburg as well. And a quick reminder, check out the YouTube channel. There's the link in the email that we sent this on. We're doing education for kids every morning, 10 o'clock live stream, just a quick, easy one. And they'll be available on YouTube. So we've got the links there, but check them out. And yes, you can forward them to friends. We're not selling anything. It's just, the kids are home. It's a great opportunity. So kids, grandkids, anybody that you can think of, let's educate some savvy investors and future finance citizens, because we're going to have to pay the bill on this thing someday. So we better get our ducks in a row, right?
Absolutely. All right. With that, have a great night.
Until next time. Thank you all. This is David Littlejohn from Roseburg.
And Wes Holt from Salem.
All right. Signing off, gang. Take care.
Bye-bye.